Hello, welcome everybody. I'm Lori Berman, Vice President of Membership and Development for the Small Business Association of Michigan. Thank you for being here for today's webinar. We're really excited to have our three guest speakers back, some regulars on this channel. Thank you for being back, gentlemen. Before I do introductions for today's webinar on the Biden tax bill, I would ask you to put your questions, any questions you have about today's content, in the Q&A feature of Zoom. If you have any other questions that are unrelated to today's content, if they're related to EIDLs or PPP loans, please send those to sbam@sbam.org. We'll answer those questions. Today's webinar is being recorded. It will live on both Facebook. Welcome to our Facebook people. It'll live on Zoom. And we'll also provide you with the slides our speakers allowing today. So thank you. Thank you for being here. Please keep an eye on SBAM's website. We have a busy month coming up next 6 weeks, end of April and May of webinars. So there's a lot going on. And this subject today, really looking forward to our speakers unpacking it. So let me tell you who we have back again as our experts. First, we have Leon Lebrecht. Leon has helped to set this up. Thank you, Leon. You brought this topic to us. Leon came to us from the MICPAs. We appreciate that partnership with the MICPAs. I know, Leon, you're on the board with that. Leon's daytime job is Chief Growth Officer of Sequoia Financial Group. He serves a team of experienced advisors, assisting them in their pursuit of providing unparalleled excellence in client service and financial planning. He's also a writer for Forbes. He has written for Our Magazine and a frequent presenter. So Leon, thank you for being back again today. We also have Bob Wines. Bob is a licensed CPA and attorney. He earned his JD from the University of Michigan. Bob has extensive startup and business turnaround, venture capital, and triple bottom line strategy experience. And Bob also came to us through our partnership with the MICPAs. And then last but not least is Jamie LaPiccolo. Jamie has been on many of our webinars. Jamie is founder and proud owner of Capricorn Professional Advisors. It's a CPA firm located in Lake Orion. Jamie specializes in providing accounting, financial reporting, tax planning, tax preparation, advisory services for businesses and individuals. Jamie is also a board member of the MICPA, and I understand he is part of their executive committee. So we appreciate that relationship. We appreciate you being here. And I'm going to turn it over to you folks and let you take it away.
Great. Thanks, Lori. And Bob and Jamie, good to see you again and good to be with you. Jamie, it's usually I would say, I hope you had a good tax season, but it's not over yet, unfortunately. So we get to go from there. The three of us have been doing lots of things on PPP and ERC and everything else. And so now we get to do, AGP. So, we have new things to go play with. Let's just have continuous three-letter acronyms and do the Society of Acronyms. Lots of things to talk about. I'm going to talk about a combination of things, the kind of the blend of all the types of things that could basically happen in terms of a Biden tax plan. I'm going to go over some of the things that we have in terms of the 35 or so bills. And I thought maybe we would just do some chat on that and just have a little bit of wrap. Does that sound good to you two?
It does, and especially with Jamie muted.
Yeah, Jamie's muted. We'll have a great conversation. I'm really looking forward to it. Yeah,
that's how you guys would. That's how you guys would like to see it, right? This is just for me to be muted the whole presentation.
Well, it's Christmas in April, but that's okay.
My significant other wants to have me all the time. So
yeah.
So I do want to start out with a caveat emptor. We're not going to be talking about the fairness of the tax system. I didn't come here to praise Caesar nor to bury him. I came just to talk about the deal. So when the Tax Cuts and Jobs Act came out on behalf of the AICPA, I got the possibility of talking to legislatures and getting some things in for small businesses like the cash balance program. This is just an analysis of some of the proposed legislation. You figure out whether you like it or don't like it. I know Bob's going to try to rope me into talking about social or cultural context of this thing, and it's not going to work, Bob. I'm not going to do it. So
I'm still going to try.
Wouldn't be prudent. I wouldn't do it. So, let's start out with our format of what we're going to talk about. So what I'd like us to hit on today, guys, is what are the prospective changes in some of the Biden legislation? I'm going to add into that the Sanders, Ortiz, Elizabeth Warren stuff. There's some stuff out there. I counted 35 pieces of legislation. This is the downside of my part-time job of looking at Washington, is trying to sort through all the stuff out there. I want to talk about, so first, what? And then the second is, what does it mean? What's the prospective results to businesses and individuals? And then I think the three of us can really talk about the logical planning moves. And then I have a little fun. I think we should have a little fun about talking about the probability and consequences of the proposed legislation. Yogi Berra always said, predicting the future ain't what it used to be. But, I think we could probably agree on that basic concept. So let's dig in. I'll just do a quick overview, if you don't mind. And the first is, this is just a proposed plan that President Biden had in his election cycle. So I just did an article in Forbes. Encourage everybody to go read it. I make 0.7 cents. And if 100 people read it, I can go buy a half.
Give you a raise.
Yeah, I get a raise.
You can buy us a drink, Leon.
Yeah. Would you like water?
Right.
But I pulled the provisions out of there, generally in order. First of all, the first one I put is in order of perplexity. And then the second is the order of the size, the magnitude. Some of these things I think are really going to happen. Some I'm pretty sure aren't going to happen. But just running down the list, one is a tax, a 12.4% payroll tax on earned income over $400,000, split by the employer and the employee. We'll talk about that. That's not going to make it through the Senate unless the nuclear option's engaged on the filibuster. Bob, you remember in law school, they taught us all kinds of things about Constitution, how the Senate works and filibuster rules. Somebody was talking to me this morning. I have a nice busy day today. Thank you. And on my morning conversation, we were talking about, they said, well, what if they want to get rid of the filibuster? I said, they can't. They go, what do you mean they can't? I go, you need a filibuster. They have filibuster, so they can filibuster to prevent the filibuster rule. So you can't get rid of the filibuster because there's a filibuster rule. So I don't see it's not going to probably happen. So you can't get through the filibuster without a filibuster. So corporate tax rate to 28%. I think this is going to happen. Something's going to happen. It's going to be probably 25, but that's very likely. 25% is more probable in the rate, but we are going to see a raise in the C corp rate, which, by the way, means there's going to be a change on the phase out on the pass-through QBI, on the qualified business income. They're about raising the top individual rate and reinstating the limitations on itemized deductions. Latest news I heard is that Schumer and some Senate Democrats are revolting, trying to put the state and local tax deductions back in. That's starting to look probable too. Taxing capital gains as ordinary income gives me a headache. Actually, I need Tums and Advil, both. So I would say it'd be called Tadvil. But that's a bad one. And coupled with that is something called a carryover basis. Luckily, I think that's a low probability, but it's a very scary one for us. There are some industry-specific taxes. Probably those will go through. Those are changing the depreciation on real estate and multifamily and commercial real estate. Guilty or not guilty, there is a global intangibles low tax rate. Bob, that's the only one I'm going to let you rope me into talking about whether it's logical or not.
I like that. I like that. Yes.
And I'll say guilty.
Yes.
Yeah, guilty as charged. And then phasing out the pass through the 400 over 400,000, that almost for sure will happen. One that'll be real weird, and all of us are CPAs, so they're going to put a potential 15% minimum tax on book income, and strangely enough, that's got a lot of traction. So you add all these up and it only comes out to $3,994. Oh, I'm sorry. That's $3,994 billion, which is $3.9 trillion, which apparently in DC, they finally started learning that no one noticed when they spent billions. So now they'll just spend trillions. So we'll run for there.
Leon, I have to comment on your symbol there where it almost looks like Bitcoin. So it almost makes the money look like it's not real. If you look at your
there you go. It's almost
dollar sign with the B, looks like the Bitcoin symbol, right? So it's not real money. Yeah,
it's not. It's just here. You want a Bitcoin? There you go.
There you go.
Or better, you want a Dogecoin? There's the one I want.
Yeah, right.
I wish I had bought. I wish I'd come up with a joke called the Dogecoin. Put it in the Leon coin, me coin.
There we go.
Unbelievable.
I've already been criticizing this slide, so I don't want to hear anybody yelling about it. I had to blend drinking and Clint Eastwood because they're two of my favorite things. So I put down, the good, the bad, and the ugly. And I could say the good is, well, I already gave a caveat emptor. In my version, the good would be don't do anything. Leave the tax system alone, or maybe throw the guilty provision in or something like that. But leave us alone would be really good. Or give us a little tiny bit of a tax increase and come up with something more fair or more interesting. And I'm again going to avoid Bob roping me into my libertarian views of flat rate tax. The bad is we get a middle ground. We get corporate tax rate at 24 to 26%. We get highline individual taxes, but we get no carryover basis. And then the ugly is, the whole thing. So I think, we ought to play with that. The three of us kind of rated these. We said there's a probability of passage. If it's probable, we give it a thumbs up. If we go maybe, and if it's unlikely, no. And then the detrimental effect to the recipient, it's either one martini, which is celebration, bad, two martinis, which is okay, and three martinis, which is I want to forget about this thing. So let's start out with the first one that I think is low probability and really ugly, and that's this weird Social Security tax. And that's a 12.4% tax on split on earned income. Jamie, Bob, can you figure out how they even came up with this? Who thought this one up? I mean, where did this come from? Any ideas or?
Look at the Social Security fund.
Yeah. Yeah, I agree. I think this is coming out of, I think they've had such a hard time trying to figure out how to solve the Social Security quandary that, let's throw it all in, it's kind of throw the water out with or the baby out with the bathwater type thing. And let's just, see what sticks, and what I find funny with this is that it's going to be how this is going to impact those that have stock options, those that have, because a lot of people, most people are still in, under $400,000 in salary until you start getting into incentive-based compensation. And so now this starts changing the dynamics of stock options and starts thinking that S corporation, now we're going to get into a discussion with S corporations of reasonable compensation. So I think this creates a little bit more problems than it really is going to solve. I mean, understand the need to solve the Social Security issue in the trust fund liability and the solvency of it, but I just don't know if this is the right way to do it.
I guess I'm looking at it this way. If you look at historically when Social Security came into being, the average life expectancy was about 68. So keep in mind, the recipients back then were males. That's who was working. So the average life expectancy of a male back then was about 68. So you got Social Security for 3 years. Now you're retiring at 65 and the average life expectancy is pushed to 80. So the system just wasn't designed for that level of longevity. On top of it, it was funded with the idea we'd always have a growing population. So the people who are taking it would be relatively small in proportion to the complete population, which is subject to the tax. We're not having that anymore. We're seeing the senior portion of the populations growing rapidly, more rapidly than the tax-paying portion. So if we want to keep the Social Security tax, or we want to keep Social Security, we're going to have to address it. And I think politically in Washington, they could look at it two ways. One, they could say, you know what, you can get Social Security when you're 72 or 73 or 74, or we can increase the tax, or maybe a combination of both is what you're going to need to do. But I think this was the way they thought, well, if we just tax the wealthy, we can keep the benefits for everyone else.
Right.
That's
This is a Bob,
you like it because it's going to guarantee you a revenue stream through the rest of your life.
Well, you're going to kill me. So yeah.
Yeah. I mean, I've always said that's the Social Security system's got to be changed. And at some point they've got to draw a line in the sand and say, we're going to, this generation or this group is going to pay for the shortfall, whether it's drawing the line in the sand at the 30-year-olds and saying, whatever, you're going to have to either forego Social Security, you're going to have to wait till longer to retire, or we go after the higher income. And I think that, this was more of a quicker fix than a long-term fix. So
I ran Steph Curry's, in my Forbes article, I ran Steph Curry. He'd pay $1.4 million more tax under this. His tax rate, and the self-employed people actually get popped up about 35% tax increase on this if you're making.
Yeah.
So
now I'm going to play devil's advocate. This is years and years ago when Leon and I were at Plant Moran. We had a client that had a very, very large sale of a very large business. And Leon had this great strategy because the partners are going like, well, what the hell are we going to tell this guy when this is back in the 80s? It's like, he's got a $2 million tax bill. And Leon said, I can tell him. He goes, no, I'd be glad to. So the client walks in and Leon's sitting there with the partners and myself. And he goes, I want to congratulate you. The client looks at Leanne and goes, no, I want to congratulate you. I said, you had an outstanding year and you were in the top, 0.1% of economic income for this year. And I just want to congratulate you. He's looking at me and said, well, thank you. He says, and because of that is part of that, here's your $2 million tax bill because you did so well. This is what's brought it, thank you. I just want to thank you for the great work you've done. And the guy was like, then the partners are laughing.
Yeah.
So
You did keep the client though, so that was okay.
Yeah. My point is that, I get it. I might pay another $1 million and I'm not diminishing that impact at all. But at the same point in time, we've got to look into proportion. What is
Steph will make 43 million. He'll make 43 million, so he'll have only 42 left out instead of the other parts.
Yeah.
That'll be the hard part for him.
Yeah.
I mean, do you think that there, a compromise could have been somewhere at a lower tax rate on this? Not necessarily, or does that create too much confusion? I mean, already trying to explain this to clients that where we're going to. I mean, obviously, it creates more tax planning for the CPA side of it, things and the tax professionals. But do you see the potential that they could even compromise on, that additional 12.4 instead of 12.4? Maybe it's 6.2, 3, 3 to each side versus the full 12.4, or is that pretty much hard coded in?
What I'm hearing is they use the OASDI rate. That's what that is. So they are using the current OASDI rate. So they're just going to say, look, this isn't anything different. All we're doing is changing the wage limitation.
Yeah.
Make up 139 grand, you pay into Social Security.
And they're already doing something like this with Medicare anyways. So,
right.
Medicare, you pick back up after $200,000. And so the concept to me is, I don't think the concept's a bad concept. The 400,000, I guess, is where you could get into arguments on whether that makes sense or not. Is that the right number to go after? I mean, that's consistent with what President Biden had argued during his candidacy, that he was going to target the 400,000 plus generate people. It's hard to say when that's at the 1%. I think this may, Leon, I think if you were to put this out to most people, I think that you would turn this into a positive. That thumbs down would turn into a thumbs up and probably turn into a one martini thing. If
most people, yeah. If you're making over 400 grand, it's a thumbs down and 3 martinis. So
yeah,
it's a matter of perspective. That's a
I'd agree with that. I'd agree with that. And you're right. You guys are both right. Social Security's got to get fixed. There's no question. Yeah. And I've said that a long time ago. You could just raise the Social Security wage base. All this is a bifurcated raise in the wage base.
Yeah.
The one I think is more probable, that's individual income taxes. And I think there's a lot of traction on this. And that's just to raise the top rate back to 39.6% and then reinstate the P's limitation. And hot off the presses from yesterday is reinstate the state and local tax deduction, which kind of I would like. This does raise about $500 billion of taxes. And I think we all ought to recognize this would have happened at the end of 25 anyway. I mean, this would have happened irrespectively. So it's a big deal. All three of us know that we used to limit itemized deductions. If you make for, what was it, Jamie, 375,000 or something like that?
Something like that. Yeah. Yeah.
So go ahead.
I was going to say, the only comment I have on this is, yes, we are expecting this to go back in 2025, but we're also expecting the calculation of taxable income to go back to 2025. If we remember, with the 2018 tax law, the Trump bill, he raised taxable income. Taxable income for most clients increased, other than those that had maybe a QBI deduction, but taxable, and the rates lowered, and that's where people got their tax cuts. Now all of a sudden, and when I saw that, my first reaction was, I bet you what's going to happen is they are going to raise the tax rates and not change the calculation of taxable income.
And that's what, by the way, Jamie, you're right. That's what it is. That's what the proposal is. So it is it's a stealth increase, because it sounds innocuous. Oh, we're just going to raise the tax rate, but it's then also a little bit malevolent, because it says, and we're going to leave everything else.
Right. Now, if they bring the SALT back, and because remember, most people lost the exemptions. And when you get into this rate, you start to lose out the credits and all of that. So I mean, it may work itself. I'd have to work through some numbers, but unless they bring the SALT back, and that's, I think, the key to this. If they bring SALT back, then this is a little bit more appetizing than if they don't bring SALT back, because then it is a much truer. It's more than just a 2.6% increase over where it was in 2018. It's not just bringing it back. It's a true, it's a higher increase than that.
Right. Well, and I think salt is starting to get a lot of traction, and that probably will be in there. The East and West Coast are all high taxpayer states. They're Democratic states. They're going to be more prone to want the salt back. If we go with the idea that affluent people are losing lots of deductions, there's people who pay lots of property taxes, farmers pay lots of property taxes, and they're limited out at $10,000. Well, so I can see a lot of support for bringing the state and local tax back. Well, as you guys know, they jammed it in there to make it work in the Tax Cuts and Jobs Act. So this one I give a high probability. We're going to probably see something.
And I like the idea of bringing salt back just because of I've got several clients that are K1 owners. And business owners that get K1s where the state taxes are sent back down to the aren't deducted at the business level, but are sent to the individual shareholder or partner to deduct on their return, and they don't get that deduction anymore. Mm-hmm. Whereas if they were a C corp or a different type of entity, they would get that deduction. So I think that bringing the SALT back actually evens the playing field.
Yeah, and we may see it. I think we might see it. Everybody's asking me on timeline on the bill. I'm saying it's probably later in the year. There's many things on everybody's agenda right now, and putting
December 31st.
Yeah, probably. Well, Jamie, they gotta buy. People have been talking to folks. I said Jerome Powell is the most important person in Washington, followed by Joe Biden, followed by Joe Manchin, followed by the Senate parliamentarian. The Senate parliamentarian has given them 2 sequestration bills they can have. So they're going to have 2 reconciliation bills.
Oh boy.
They got to get them done. One before June 30th and one after June 30th. So you'd probably see this on June 29th, and you'd see the second one, whenever that is, on December 31st at 2:00 in the morning, because they all went to Michigan State and don't know that December 31st at 2:00 in the morning is actually January 1st of 2000. But
I think you just lost half the audience.
No, that's when my son would do his deadline. So if the deadline was the day, he always did it at 2:00 in the morning the next day, knowing the prof wouldn't be up. So, so let's go to capital gain taxes. Capital gain taxes increases the minimum. The slide's a little bit wrong. It increases the minimum tax on capital gains. It raises about $448 billion. It's a huge increase on the upper income. If you've got $1 million capital gains, and everybody's going to say, well, who has $1 million of capital gain? If they put in something called carryover basis, that would be dramatic. So people who sell their businesses, we're on with the Small Business Association of Michigan. I hope eventually we're all on the Large Business Association of Michigan, all the people on the call. But that would mean that we sell our business and go make $1 million gain. That's out there. It also taxes gains on people who have qualified business income. It taxes gains on people who have real estate. And I did a study on what happens when this happened in the past. And basically every time we raised the capital gain rate, this S&P 500 went down within the next 6 months. Sometimes, usually on average around 10%, but sometimes as much as 20%. So this one I'm worried about. I don't think it's high probability. I'll go backward to my slide. It's a low probability, but it's a big headache. And at the carryover basis, I think, Jamie, you probably pull out your hair and look like Bob if we have.
Yeah, that becomes, I mean, for the group to understand what carryover basis, this is really, you're referring to the step up in basis on one of them is the step up basis when somebody dies, we get the value. The basis is at the date of death, which helps make things a lot easier when, mom or dad have owned the house since the beginning, since they first moved in the early 50s, and then they die in that house and sell the house, and then the kids sell the house. All of us, we used to be able to calculate the gain based upon the date of death and whatever it gained from the to the sale. Now what you're saying is that we have to go back to what mom and dad originally purchased the house for, because we don't get that step up. And that's going to be, I've ran into a few of those in my lifetime, and you kind of do one of these things and go, I think that's the number. Right. This is going to be, I just don't like this idea here. But they were talking about that with the new estate tax, going back. So I think this is interesting.
Well, here's what's scary. They're talking about putting these on top of each other, layering.
Yeah.
So they're talking about cutting the estate tax and putting a carryover base.
Yeah.
Which takes the estate tax, I'm going to talk about that in a minute, up to 45%. But it also then takes the capital gain tax up to 39.6%. Now, of course, we know what's going to happen. If you're rich, you're going to go hire a bunch of smart advisors who are going to figure out how to get you out of it. But
Yeah,
if you're in the middle, this is going to kill you. If you're, if you got a farm that's worth $2 million and you got it from grandpa who picked it up at 40 grand, you're now talking about potentially paying a whole bunch of tax. And
and I just don't like when they screw around with this relative to business owners and the capital gains that business owners can, they work their entire life, build up a good business, exit out, and then all of a sudden they don't get the benefit of the capital gain treatment. I think is just detrimental to business. What's the incentive for business owners to grow their business at that stage? I don't like this one at all.
Is there any rumors, comments in Congress regarding changing the rule so that if it's original issue stock, you still get capital gains? So I'm the small business owner. I still get capital gains. But if I'm buying IBM stock, which has been resold 20 billion times before I got it, there's no new investment going to IBM. I get that. But I'm investing original issue. I'm making an investment in that company. And there are tax provisions, as you know, which give me a tax advantage for original issue. Are they planning on keeping that, retaining that, expanding that?
They never tell us what they're going to do. What they do, they get all these theories, they pass them around and write a paragraph, as you all call them. And so I get to read the paragraph and go, what the heck are they talking about?
Right.
Usually at about 11 o'clock at night, or actually, like I said before, at 1:59 a.m. on 12/31, they release a 2,378 page bill, which then I have to go take a bunch of caffeine and Adderall and go stay up and read the damn thing and figure out what they said. As you indicated, Bob, if I have a small business right now, there's a section 1202, which allows me to take a tax-free gain on a small business if I do it right. And if I pay attention to that, maybe that'll stay, maybe it won't. Hard to say. We were talking on a PPP session the other day, and there's a piece in there for a PPP3. Don't watch Jamie fall off a chair, but there's a PPP3 sitting in there for low-income low-income areas. So I think this one could happen, but I think it's a bit. I hope it doesn't happen. It's too crazy. And if you notice the chart on the right-hand part of the screen, the S&P 500 has declined pretty much almost immediately after every capital gain increase. It then keeps working its way up. I'm a capitalist, and I believe in the markets, and I believe that our economies grow and that human beings are functional creatures that can adapt. And I think that adaptability really works. But I just see that there's issues here on this. So I'm hopeful that this one doesn't pass. Another one that's coming into play, this could actually be a really good one. I was pointed out to somebody pointed out to me, they go, you're saying that this could be bad. It's probably not bad at all. It depends on who you are. They say you're tipping your hand on who you advise all the time. This is to equalize retirement plan contributions by giving everybody a credit. So you get a credit at about 26%. So instead of getting a deduction for your 401k, you get a credit for it. And so to me, if you're in the 39.6% bracket, that's a tax increase. But if you're in the 22% tax bracket, it's a tax benefit. So this one's one of those ones I should probably just rate it, thumbs up, thumbs down, depending on who you are. I'll go, eh. And it's not a 2 martini. If you're under the 26% bracket, this is actually a full, hey, you're making money. This is a full green martini. And if you're in the high bracket, this is a two yellow martini. It's not going to kill you, but you're not getting the full benefit. It will on some people make them look at Roths, and on other people make Roths less attractive. It's kind of interesting. What do you guys?
At first glance, I kind of, from a planning perspective, I kind of like this because it now, I mean, we always have the conversation with people that make contributions. Well, it may not make sense to do that because you're in a 22% bracket, or you're in this bracket and you're going to exit out at a higher bracket, or vice versa. Here it kind of, and it always has that crystal ball of where things are at. This kind of, I think, settles that debate a little bit and says, we know you're going to get a 26% savings going in, and that's actually enough incentive for a lot of people to say it's worth it. And now, depending on, we don't have to worry about where rates per se are at when they come out of it. So I kind of like this overall as a planning tool. And I mean, I'm always a big person of I just want consistency and as much known as possible. For the last 30 years, my crystal ball has not worked at all. And so this helps give some clarity to the situation.
Actually, I like this from this
Yeah.
perspective. From a policy standpoint, I say the goal for motivating retirement planning contributions is really to get the people who are at the lower tax brackets to start savings. If I'm making $1 million a year, I'm not worried about my retirement planning unless I just can't budget.
Right.
But if this gives me the motivation to save because it's simple to calculate and wow, look at the savings I got instantaneously. They help fund it. From a policy standpoint, I like it.
Yeah.
I agree with you, Bob. I mean, if we're always trying to, the lower income group doesn't go save, but this would encourage people in a lower income group to save. Say, look, you put $1,000 in your plan, you get $260 back. They go, really? As opposed to somebody who's in the 12% bracket, they're going, well, I'm only getting $120 back, and I need the money, and I need to go buy something, and I got to, I mean, this is a push that way. So I'm going to go on the social basis to say this is actually good for the country and good for savers.
And I think that more
in the higher bracket.
I have a feeling that if they put this in place, they'll probably get rid of the credit for foreign or for retirement tax, which very little people get anyways, but the retirement tax credit, I'm assuming that's going to swap out. Hey, Leon, I don't know if you saw that there's a question on there. Somebody asked, I don't understand how taxing foreign income then becomes death tax on farms. I think that the slide was
it was wrong.
It was a typo. So instead of foreign income, it should be capped right.
Yeah, it should be capped.
Sorry, that's capital gains.
Yeah.
Apologize for that.
Yep.
I'll fix it. Let's go to the estate tax. I am going to get in foreign income. That's why this is the trouble when you do a slideshow. If anybody knows that, you copy your slides and then keep it going. And that's one of those ones that laid on there and stuck in there.
Right.
So there's talk about reducing the annual exclusion to $5 million. There's the Saunders-Ortez bill out there of $3.5 million. That's to take it down from the 11.7. There's traction on this. This could happen. It's going to happen anyway on 12/31, going down the half rate. So it could happen sooner. That's all it is. It increases taxes on heirs of wealthier families with assets above $10 million. I'm not sure everybody is got a whole bunch of sympathy for heirs of wealthy families with more than $11 million. So it probably means more estate taxes, less transfers to wealthy heirs, and hits wealthier families. There's plenty of appetite in DC to tax people in the upper 1/10 of the 1% bracket, and that's most of the people in the estate tax. And again, to make an interesting one out of it, when they were originally doing the Tax Cuts and Jobs Act, and I was talking to members of Senate Finance and Ways and Means, they kept calling it a death tax, and I kept correcting them. It's not a death tax, it's an estate tax. And then I said, it's actually a transfer tax. It's not either, just causing the transfer back in to be death. And they kept talking about farms. I looked up how many farms in 2017 paid estate taxes. Out of all the estate taxes paid by every estate in the United States, 100. There were 100 farms worth more than $20 million. So we're talking about, this isn't hurting many people, and the people it's hurting, like Bob likes to say, can still afford steaks. So I'm thinking this will just be a boon in terms of estate planning, but it is going to be, this one could probably happen. I'll go with, and it's for those folks, it's a 2 martini. For everybody else, no one even cares. It's a no martini. So
Leon, this was probably a bone thrown to the attorneys. They needed more work evidently, and so somebody's throwing them a bone.
Yeah.
Because it's going to be. I mean, the only question I have on this is, and I've always wondered this, is when they raised that estate tax to the 11 million, in commonality for the upper is to either do some planning around that, gift it out, or do whatever. And if they've met that exemption in their lifetime, and now they drop that $5 million, what happens to that? Does that $600,000 automatically become, is it become taxable again? And if they've already planned for the 11.7 and now we've pulled the rug out from underneath them, what happens now? I'm kind of curious at how they decide to handle that.
We're taking clients that have lots of, if they've got 22 million, we're telling them, get rid of it, give it all away now in certain forms of trust or other things, and burn it up while you still can. So burn up the exclusion while you got it, because once you got it, you're there. By the way, the Saunders-Cortez Warren Act bill is retroactive to the day they put the bill in place, because you can't get around that. That one's probably not going to pass. But Jamie, in answer to your question, usually you burn it up. And if you burn it up, you get it. You get to keep it. If you didn't burn it up with a gift, And then you
Right.
set it some other different number, then you're stuck. You're stuck with the new rule. That's why you got to plan.
Yep.
Bob,
Are we
were you
gonna
gonna say- or did I?
No,
Are we
I,
gonna
I was going to say the same thing you did. So perfect.
Are we going to create some sort of a charity where they could just donate it all to us?
Sure, let's do
Yeah.
that.
There we
The
go.
SBAM Memorial Private
There you go.
Foundation or something like that.
Anybody that's got a estate worth, they want to, burn up the $6 million before they change it, we'll give them we'll set up a fund for them.
And a T-shirt.
Yeah, I gladly give them a T-shirt.
So let's go with the corporate income tax. And I'm giving 2 martinis because it affects everybody. It is very highly probable. Again, socially, you can argue a lot of things about corporate income tax rates. There's an argument that there's competition worldwide, and I'll get into one that I actually would tend to support a lot more. It's a big tax increase. This was the biggest tax cut in the Tax Cuts and Jobs Act, and this is obviously the biggest tax cut in here. Highly probable we're going to see a change in the corporate tax rate. It means that the external S&P 500 earnings are going to drop by about 9% if we use the 28%. It also means that smaller C corps, Jamie, and you do some C corps, smaller C corps will be affected by this as well. It just means that we're going to have to do a lot more planning. It's going to be, looking at how companies try to work within this in terms of their stock holdings, what they're going to go do. I did a little bit of a study with some friends of mine from Strategis, and we looked at the basic corporate tax changes between the impact of the tax bill. It takes the consensus estimate down about $11. It takes the stock market down by 6 to 9%. If the multiplier changes, it takes it down to 6 to 9%. The stock market hasn't been noticing this. They're not listening apparently to these things. This one is a very highly probable piece, and it gives rise to some of us thinking that there could be a stock market correction. Perhaps the passage of this bill would precipitate some of that. But there's definitely going to be something coming out on corporate income tax. What's more important is how they correlate this with foreign income, which is what our astute viewer watched. What happens on foreign income will make the biggest difference, because right now, as the 3 of us know, if you're getting 28% corporate tax and you're Apple, you go over to Ireland, you get the Irish prime minister drunk, and you get him to give you a special deal for 2% tax for 10 years. And then everybody yells and screams at you, and you say, well, I just got smart tax attorneys. Now what you'd have to do is say, no, you're going to have to pay tax on your Irish income, and you're going to have to pay tax on your U.S. income. And so no free lunch. There is an interesting thing floating around that may or may not happen. It doesn't seem to have lots of traction. And that's to have a worldwide treaty that says everybody's going to have a minimum tax. And if your country doesn't have a minimum tax, the United States will impose it and keep it. So you either impose the tax on stuff consumed in your country, or we will. And so the Irish can't have a tax haven anymore, or if they do have a tax haven, anybody using that tax haven will have to pay U.S. tax on it anyway. Socially, that makes some sense, because it kind of, Apple's a nice company, but if you got $2.5 trillion and you can go hide a couple $100 billion offshore, it doesn't, that's not what the ordinary person who buys an Apple phone gets to do. So I think that's an interesting piece there. Any thoughts, guys?
There's a lot to unpack with this one. I think, the first thing when I looked at this, Leanne, is we did a presentation, several months back about the CARES Act and going the NOL carrybacks, right? Now, how important it is not to carry the NOL back and maybe leave it to go forward to offset 28% tax dollars now. So there's a lot of planning that needs to start early in anticipation of this. I agree. I think this is going to change. I'm okay. I'll be honest with you. I'm okay with the 25% rate. I think that's a fair rate. I think that's, from a policy perspective, I like 28. I think is a little, to get that high, I think is a little bit, because that's still more than the it's still much more over than the individual rate. So it's still going to make S corps become more attractive, and corporations are going to end up paying less taxes for this group that we're talking to. I think one of the things that I had read that scares me the most relative to the way they're presenting this is, and I think I emailed both of you guys earlier or late last night regarding is the provision that they're talking about when you have a foreign-owned corporation in the U.S., and a lot of auto manufacturers do that. They have a company in Germany and then or wherever, and they open up a U.S. subsidiary, 100% owned, and they have transactions back and forth. They're talking that if your country the parent country doesn't subscribe to this worldwide tax, then the expenses you pay to them are not going to be deductible, which increases the U.S. tax. So that part scares me, because I have a lot of clients, and I mean, they're not rich by any means, and you know, the companies are doing very well, but this is that makes them less competitive to the U.S. other U.S. companies, because now all of a sudden they've got a higher price point, and I just don't know if that's going to, you know, that part I don't like.
Yeah, I'd agree with that.
I look at this and I think it's academic for most of us as small business owners, because most of us are using some sort of pass-through entity. So the C Corp structure isn't core to us. However, from a policy standpoint, and like I said, Leanne, I love going back to the policy, drives you nuts. Actually, it doesn't, you love it. Is the idea of having a minimum, let's say international, the you know, tax sitting out there. It does make sense, because it keeps the country doing a race for the bottom. Just like you said before, if I'm Ireland and suddenly I cut a special deal for a certain segment of the industry, it simply is drawing people away. I mean, we were both at Arthur Andersen, you and I, Leanne, and you know, Andersen Consulting split off, and when they became Accenture, where'd they go?
Ireland, I think, right? Yeah.
Yeah, they're in Ireland. Why? Only for tax reasons, nothing else.
Right.
So from my perspective, I go, from a policy standpoint, I don't think anyone thinks a race to the bottom makes the most sense. We as businesses don't want to say, well, you know what, we just want to continually compete on price alone. We want to compete on value, on service, and other things. And if we can then have our corporations have to compete, look at the countries on the same basis. What country is offering me not only a good competitive tax rate, but other services and resources that I need to grow? Then we've got, I would say, that's the way we want to be setting our tax structures and competing. We don't want to be competing just on price.
I'd agree. And Jamie, I would agree with you in terms of the 21%. It's just that it's that competitive feature. I think, you know, the 20%, we should recognize, Jamie, you brought up QBI pass-through into entities, and Bob brought up pass-through entities. If they change the corporate rate, they'll have to change the pass-through QBI rule by 20%, because it's a 25% tax increase to go from 20, you know, so they're going to have to do that. So recognize that even if you're getting qualified business income, which by the way is set to expire in 2025 anyway, that would change. And so pass-through owners would get a tax increase. Because
that's an interesting point that you just brought up, Leon, is, you know, we've always said that the QBI creates, you know, and the S Corp pass-through, you know, when the tax law passed, the 2018 or 17-18 law, we had this discussion: do we become a C Corp, do we stay S Corp, or whatever? And we felt that, you know, at the end of the day, that the QBI kind of leveled that playing field of the lowering tax rate at the individual level. But can you imagine if they pass this bill, increase the tax rate to 25%, change QBI, but don't renew it in 2025? Now what are you looking at? Now all of a sudden the playing field is no longer level, right?
Right.
And now
C Corp looks better, maybe, right?
C Corp start to look a little bit better. I mean, you know, and again, this frustrates me to all in, and this is just a personal frustration, is the most inconsistent thing or is it the tax law? Right. You know, it's, I think that businesses overall, and I think you could talk to a bunch of CEOs, CFOs, give us the rules, we'll figure out how to play by them, but stop changing them. Let's just play with the rules that you guys are comfortable with. You made them. Let's stop changing them, and let's just worry about it from there. And that's I think the biggest frustration, especially from small businesses, is they just want to know how to play. They want to play by the rules. They just hate that the rules keep changing. Yeah.
Quit changing them all the time.
Yep.
Let's take another one, because I want to be conscious of our viewers' time.
Sure.
Three specific taxes would be basically affecting mostly real estate from what I'm reading on this. This is commercial and multifamily real estate. It's through depreciation changes. It's accelerating depreciation. It does affect REITs. It will affect higher taxes on real estate in specific areas. It would be, if it's like all other depreciation changes, it would be for depreciation on acquisitions going forward, not going backwards. So, those of us have been around a long time, which is basically the three of us remember when they changed the depreciation rules several times. It would be for acquisitions after a certain part. This is worthy of us discussing the effective date. Most tax bills have an effective date at the beginning of the next year. Some have effective dates farther out. So far, what I hear from DC is that we're looking at an effective date of these passages, at least most of the ones we're talking about today, not the ones in the Sanders bill, would be January 1st of 2022. Now, it could be further out, could be, who knows? If the pandemic keeps going and economy suffers, they may not do this at all this year. If the pandemic settles down and the vaccinations start working and we get the economy as smoking hot as it appears to be going, then you could see this 2022. If we start really going off the map and they want to go raise taxes, they do that. I'm presuming that the party in power is much more interested in spending money than getting it. So this would be a kind of an afterthought of being able to make some kind of a social claim that we're not spending money like crazy, and say we want to go build infrastructure and we raise $2 trillion of taxes to spend $2 trillion on infrastructure. And I think you'd see some activity there. This one I'm not completely worried about. It does equalize the playing field. Real estate has been a shelter. I do find it kind of interesting that it's commercial and multifamily real estate, which seems to be the wealth of the prior president. So I'm wondering if this isn't kind of a payback, but I'm not going to make that call.
All his tax savings came from depreciation. Remember that?
Yeah, I remember that. Yeah. And he
that's
paid
always
800.
yeah. The funny thing is depreciation is such it's a timing thing, because you pay it back when you sell the property. So It just reduces the amount of the payback you have to do on the back end. So I'm not, that one doesn't scare me.
It doesn't scare me too much. This is a highly probable, and this is one that probably I think all of us could agree on to a degree. That we've talked about this before. This is the one where my slide goofed up on the previous one on capital gains. The global intangible low tax income tax. It's to put a minimum tax on non-U.S. income, and this was in the Tax Cuts and Jobs Act. This was already there, except it got all watered down by Treasury, who said, "Oh, you don't have to do this, you don't have to do that," and the IRS said, "You don't have to work with this kind of stuff." And basically, everybody who was subject to a global intangible low income tax didn't have to pay it. This takes away all the loopholes of it and just puts it back in, saying you can't take all your patents and put them in Ireland and say all my patent income goes to Ireland. You can't be Apple and have all your patent income. 90% of what you make on an Apple computer is patents, and that's all in the Irish subsidiary. Sorry, no cookie for that anymore. What does it mean? There's quite a few companies. About 25% of the S&P 500 has this kind of a gig going on. So it's going to hit the big tech companies. It'll hit them a lot. It'll hit the Apples. It'll hit the Microsofts and the Googles a lot more than it'll hit some of the other ones. It hits mostly information, professional, scientific, and technical companies. It hits management companies. Bob, you said Accenture. Accenture's right exactly in the sights of that, because they're going, wait a minute, you're paying 3% tax and you're making, Accenture's making what? Hundreds of millions of dollars. And then it also hits a lot of the finance, insurance, and real estate companies. Socially, I'm for, hey, everybody should pay their fair share of tax. Why is it that a U.S. company pays, 20%, 21%, and Irish company pays 2%? That doesn't make sense to me. So I think this will pass. I don't see there's going to be a lot of pushback on that. Big business has been pushing hard on trying to get a lot of things changed in the bill already. No big surprise. This is one they're trying to get around. Well, it'll depend on what the Congress sees on this one.
This is one where I look at it and go, realistically, some very smart individuals found a very ingenious loophole. And they maximized it, and now they're saying, oh, you're trying to take advantage of it. No, I would simply say, and Leanna, you and I used to get paid lots of money to find these very creative loopholes. I don't have a problem with those going like, no, it's bad tax policy, we need to correct it.
Yeah. It's bad tax policy, and we need to correct it. I mean, it just seems to make sense to me in a global world where we are. I shouldn't be at an advantage to move my intangible properties over to Ireland. I should just be in the same boat as keeping them here. In fact, if you're trying to keep jobs and keep profits here, why don't you want to do that? So,
and small businesses can't take it.
So somebody's got an Irish subsidiary with a patent. I'm sorry if I offended you, but other than that, everyone else we'll collect it. Pass-through income. this has to be set, as Jamie, you and I and Bob were talking about a minute ago. They're going to have to do this. I think your point is provocative, Jamie. What happens if they don't do it, and or they do it, and then the QB then it expires in 12 of 25 anyway? Then you've got this really wild thing. Well, of course, we'll be in what, 2 different sets of Congresses by then, 1 different set of Senate by then, and potentially another president by then. So we'll see what that all means. The only thing that I can see is certain is change. Let's hit on a weird one. It's not a too weird one. It's a weird one that I remember from me being an accounting professor, and that's the minimum tax on book income. How long have they been keeping 2 sets of books, Jamie, in accounting? Was it cuneiform invented then? Is it from the Assyrians, or was it?
It goes back to the pre-abacus for sure. But
right.
Leon, I get that this is going to be on the very high net income companies and not going to be touching a lot of small business owners and stuff. But this one perplexes me. It really does.
Well, it's a tax on, so for everybody viewing, book income is what you make and tell your bank, or what you tell your shareholders, or what you tell your investors. And then taxable income is what you tell the IRS. And believe it or not, it's legal to tell them different things. It's not illegal to tell them different things. So you can say, if you're a car dealer, that the last car in is the first car out. And you can tell that to the IRS, and you can tell your shareholders that the first car in is the first car out. Now, if you've been to the car dealership, of course, it's more like the first car in is the first car out, but you can do that. And that actually dramatically changes the way your inventory is reported. Then dramatically changes your income. So so if I made ball bearings and I had a mountain of ball bearings, and I said the first one's in or the first one's out, is ridiculous, because the first one in was the one at the bottom of the pile. I didn't get that. I'm always taking the last ones in. But I can tell my shareholders it's first in and first out, and the other one's last in and first out. I can tell my construction company shareholders that I'm going to give you income based on the percentage of completion. So if I'm working on I-75, which will never be completed, but I'm working on I-75, I'm 40% complete, so I'm going to declare 40% of the income. Then I tell the IRS, hey, I'm going to only take all the income when I complete the contract, which will be, since it's I-75, never. So, or 2075, that's why it's called 75. So the idea is, I can have different accounting methods. This will be, of course, another Equal Employment Opportunity Act for CPAs. So all of you who have kids out there getting ready to go to college and they're going to Michigan State, have them take accounting instead of supply chain, because accountants are going to be in really busy state for quite a few years if they pass this.
Does this make deferred taxes go away?
No, it doesn't, but it still changes it. Yeah. I was playing with Amazon. Amazon had book income of $19 billion more than their taxable income. That shows you how good their accountants are. And that would cause them to get hit with an additional $1 billion tax.
Yeah,
so it would be deferred income still. You still have
it. At the end of the day, the differences between what you report on taxes are timing, what we refer to as timing differences. And eventually they, as the longer the company is, the chances are they'll start to reverse and go the other way at some point. So this is just a earlier money grab is what this is to me.
Yeah, sooner or later. And I think of a car dealer who's been in business, we've seen them around Detroit, car dealers that have been in business since the 40s, and they've got LIFO inventory they've been using since then for LIFO reserves of $3 million.
And we got not a lot of time left. The only question I have, when they pull stunts like this and do this concept, again, going back to the concept that change, I don't see this provision, even if it does go through, even though you've got a red down arrow, I see a Republican president or a Republican controlled Congress this being agenda number 1 to get rid of, possibly. And now what happens? Because now you go back to taxable income, but you've paid tax on all. Now think that one through long term. I paid tax on this money already, but then I recognize it later down the road, I just don't. It gives me a headache already. So I think this is a 3 martini drink, is what this one is, to be honest with you. but just thinking of it down the road.
Well, it is to us as the accountants, but I look at it and say, if I'm a small business, and I would hope Congress would put some sort of, floor on this.
There is. It's $100 million. There is a floor. So that doesn't drive me crazy. That wouldn't be killing everybody.
So
Yeah,
Bob,
so-
you're right at the cusp there.
Yeah, well, yes, exactly.
Yeah, last time I looked, Bob's book income was 99 or 98. Well,
Yeah.
98, I think you got.
So I'm not worried about it. So that's
I got you a couple write-offs. So
Okay.
let me wrap it up a little bit. I just thought, what if, we ought to be thinking, what if? This is the question.
Yep.
So if corporate taxes increase, stocks are going to probably decline, at least in the short time. What does an individual income tax increase mean to you as a business owner? You know, if the capital gain rates increase, the stocks have some likely decline and increased volatility. What does that mean about your business and your business holdings? Carryover just creates all kinds of volatility. Guilty tax increase means that stocks that are international will have, will probably decline. And big book income minimum tax is a big effect on many industries over that $100 million. So a couple things on the what else I just thought we'd want to play with. They are talking about putting a drug pricing tax in there, making some kind of a drug pricing where drug companies can only charge a certain amount. There's a scarier one, a financial transactions tax, which is to basically have financial transactions like buying stocks or using, even writing checks and doing other things being taxed. There's a carbon tax proposal out there in the 35 bills out there. There's a national sales tax proposal out there. And then, of course, we haven't talked about Michigan taxes. What happens if they put the retirement credit in there? And then what happens to your 401k and your Michigan return? That has another implication. So those are the things that we ought to be, I think, thinking about and playing with. So our next steps, we ought to be vigilant about the changes. I think if you're going to go see your CPA, you ought to start talking about this after May 15th, but you ought to start thinking about it. Don't ask them what to do yet, because we don't know yet. We've given you some of the things to think about. And I think we should all be aware that there's level 1, 2, and 3 effects. You heard the three of us just going off on some interesting thoughts that we usually do over a martini and trying to come up with where things are going to go and what things can happen. So we're just telling you, you should be asking the question, what if? So I'm going to turn it back to Lori, if you don't mind.
Thank you. Yes, great. And Leanne, when you get a chance, shoot us that in between your webinars today. We'd love to have a copy of that so we can share the slides with everyone. Great questions, a lot of content. Sounds like you've done a lot of research and looking. Glad you're a part of having a voice in that legislation nationally, and that's great to hear. Thank you so much for unpacking this for our members. I'm sure there will be many questions going forward. It looks like there's one question that just popped up. Oh, said thank you, great info. So again, always engaging. Thank you all for being here with our members today, and thank you for those who are participating. All right.
Jamie, Bob, great to be with you. Lori, thanks a lot.
Good to be with you.
Us
Thank
band
you.
Yeah,
members,
good luck with the rest